Welcome to Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the S&P 500. I'm going to cover the ASX 200 as well as copper, gold, oil and uranium in a separate video. I'll leave a link for that in the description section below. As always, everything today is general commentary only, doesn't take your personal situation into account. With all that said, let's get into our first chart. So I've got the S&P 500 here on the screen, and this has been a week of non-confirmation. There's been all-time highs in some segments of the market, but then there have been others that have fallen short of their previous highs. So does this hint at trouble, or are some of the indices just slow in confirming? Well, I've got some charts to help answer that, and I'm going to go through some of the possibilities to hopefully help you manage your way through this period that we're currently in. I'm going to come back to the S&P 500 in a moment, but first, let's start with the all-time highs. Let's have a look at the Dow, because the Dow has continued its series of all-time highs with a new all-time high this week. There's a clear sequence of higher lows and higher highs, and the price remains above rising moving averages. So I have the 50 and the 100-day moving averages, and this has remained the case for much of the last coming up to the last 12 months now. So this is, I think, by definition, this is a bullish structure. This is how bullish structure appears: price above rising moving averages, making new all-time highs. When we look at the S&P 500 on an equal weighted basis, the same applies. I think this is particularly important. Now, just to distinguish between the S&P 500 index and the S&P 500 equal weight, the equal weight is, of course, ranking each of the 500 stocks equally, as opposed to the S&P 500, which is market cap based. So the bigger stocks have the most influence. And when we look at the equal weight, it shows I think what this is telling us is there's broad-based participation in the rally. It's not just limited to a few big tech names. We're seeing the equal weight at a new all-time high. I think that's a positive thing. I think the underlying structure to the market is positive. I think the question mark concerns what's happening or what may happen in the near term. So the S&P 500 is yet to make, as we were saying, the S&P 500 is yet to make a new all-time high. It's only marginally below the current all-time high, but nonetheless, it's not confirming the highs we're seeing in the Dow Jones and in the S&P 500 equal weight. The same applies when we look at the NASDAQ. And to a greater extent, it's an even greater non-confirmation than we're getting in the S&P 500. Now, non-confirmation doesn't necessarily need to be bearish, but it can be a sign that upside may be limited in the near term. And this could simply just mean more consolidation of the gains that we've seen since October last year. Big rally. It's quite conceivable there's still more consolidation to play out. Let's just go back to the Dow for a moment. Coming back to the Dow. Now, what I want to do, I want to add on an RSI. I think this is interesting to consider the market from the perspective of looking at an RSI as well. So that's, of course, a relative strength index. Now, so this is the RSI down at the bottom of the chart, and the Dow at the top, and we've got divergence. So divergence happens when you get a market makes a new high, but when you look at the RSI doesn't confirm that high. So we call that divergence. It's you could call it negative divergence or bearish divergence, but nonetheless you have that non-confirmation, and this, by the way, isn't the be all of end all. We have periods where non-confirmation doesn't lead to anything. So you can see this period through here, the RSI was falling, but the market was rising. So it doesn't necessarily mean there's going to be something bad happening, but it can be a sign that a market its upside is limited, at least in the near term. Same applies when we go over and we look at the on an equal weighted basis. You can see we've got this same divergence. Market's rising and we're not seeing that come through in the RSI at this point. So I just want to be clear. I don't think this non-confirmation and the bearish divergence, I don't think that means that there's a large decline or anything like that in the makings. But I do think the bullish trend, which remains in place, maybe it's a case that the upside is limited in the near term. There's more consolidation to come. So let's just go back over the S&P 500. It could be a case, I think it could simply be a case, the S&P 500 needs to do some more work around the moving averages. Maybe we see the price come back to the moving averages, or perhaps it travels sideways for several weeks while the averages catch up. And then maybe that provides the platform for further gains later in the year. From a seasonality perspective, September's also the weakest month of the year on average. Doesn't play out every year as the weakest month, but on average over time, the S&P 500 has typically done its worst in September. Seasonality for me, I look at seasonality a bit like a barometer, not like a map. So I don't think it tells us what's going to happen or where we're going, but it can give us an idea. It can be helpful at times. I think when we couple the seasonality factor with the divergence and the non-confirmation, I think it raises the odds that we could get a pause in this recent strong period that we've had over the last few weeks. Now, I've got one more chart for you. First of all, though, if you're getting some value from this, please hit that like button. Please leave a short comment. Just tells YouTube you're watching. YouTube shows other people. Helps me heaps. So please do that. And click that subscribe button if you haven't already done so. Now, just quickly, one more thing to show you. This is the percentage of S&P 500 stocks above their 20-day moving average. And this has hit 90% for the first time this year. So 90% of S&P 500 stocks are above their 20-day moving average. Now, this isn't a reversal indicator. You get lots of times where a lot of stocks are above their 20-day moving averages and overall trends continue. But it can be a useful guide for when a rally is close to a pause. And you can see when you compress this over time, you can see that when we do see a lot of stocks, do see about 90% of stocks up above those 20-day averages, often stocks have had a bit of a run, they become stretched and they pull back. And I think that's maybe what we could be looking at now. So I don't think any of this changes the main game. I think it's still a case of staying long and using wide trailing stops to try and see off any potential pullbacks. But I think being aware of these factors could help. It just could help with timing of new positions. I think at the moment, I think it's a case of being patient and waiting for the right setups to appear. So look, hopefully that has been helpful. Let's call that a wrap for this week and look forward to coming back, talking to you again next week. Till then, bye for now.